Alright guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review some Chinese stocks, review their most the outcome that I anticipate for tomorrow's trading session on those key Chinese techs. And yeah, so let's get to it. Alright, first of all, let's review the dollar index like usual. I anticipate a break below this level. And we go down to the 10-minute chart, and as you guys can go ahead and see, zoom in a little bit, and already we are in a somewhat of a downward trend. However, we were able to climb back to the 50-day moving average. We are experiencing some resistance there. Now, if you go all the way down to the 1-minute chart, you guys will notice there's a clear, I guess it's been able to find some support, but as long as we remain below this trend line, I believe that markets will continue, at least the dollar is going to most likely continue going lower. So I'm a little skeptical on the dollar. I don't think anything has fundamentally changed. Therefore, the dollar will most likely continue its downward trend once the Federal Reserve starts their open market operations, which start at around 10 to around, give or take 10 to 12 a.m. Eastern Standard Time. That's when you see a huge drop in the dollar index usually, and that's also when you see the bonds take somewhat of a drop as well. Therefore, the dollar drops. Therefore, the stocks rise a little higher. And of course, it pushes bond investors out of out of bonds into the stock market, and they use that money, I guess, to make trading decisions, and that in turn adds liquidity and volume and a little more demand. So, yeah. Anyway, just some extra background information there, but let's go to what we really want to cover today, and that's pretty much the Chinese stocks. And right now I'm going to go ahead and review some stocks, a stock called Youku.com. And Youku.com, I do feel that it will find somewhat of support and continue going higher. And I think it's just going to keep on continuing its upwards trend. I think we did have a short-term pullback in play for a moment there, but the Hang Seng is really strong right now. Believe it or not, the Hang Seng is up by around 1.17%, and I think that it will just keep on adding to that momentum. So, don't be surprised, guys. I mean, Hang Seng is, it's really in it. It's really bucking the horse in the overnight trading session. So, I think that Chinese stocks will be relatively strong tomorrow, particularly Youku, because it is it is jumping back from a pullback, and stocks that jump back from a pullback tend to have an extra 2 legs afoot and jetpacks along with it at times, especially these Chinese companies. So yeah, don't be surprised. I mean, demand just seems to fly through the roof for some weird reason after a pullback. And there's a couple of reasons for that. When a stock pulls back and it has a lot of beta, oftentimes you'll see the speculator take advantage of that. You have the value investors who want to buy in at a discount at a lower price, and you also have the person that's shorting, covering. You have the person that missed out on the rally looking to buy back into it. You have people who have a position in Youku.com and they want to add to that position, therefore they want to buy into those pullbacks as well. So the area of a pullback in a stock like this is very tight, very limited. Therefore, one could only assume that when a pullback happens of this magnitude and you see a very strong indication coming out of these Chinese markets overnight, you should anticipate a really strong trading session in tomorrow's on Monday. So yeah, that's what I anticipate out of Youku.com. It's coming from a pullback and in an uptrend. So you got to be pretty positive on Monday's session on Youku. Ticker symbol is YOKU. Now moving on, I am going to go ahead and review Dang Dang. Dang Dang has been slapped around, quite literally, like slapped around for the last 3 months. And institutions, I guess, are just pummeling the stock. And I think there's a good reason for it. Not a justifiable reason, but there's a good reason behind why they're doing it for their own sake. And I know for a fact these institutions already plugged in the math. They made their own value-added judgments. And I'm more than certain they're probably using the same exact formula that I'm using. And it pretty much goes like this. Net income times 8.5 plus 2 times the expected earnings growth rate. Now, and that's percentage growth rate. And right now we're sitting at around 70 projected earnings growth rate for 2011. It couldn't be that hard to beat those expectations. I wouldn't be surprised if they honestly did. Now, with these projections in mind, if you multiply the current net income at 17 million times 8.5 plus 140, you obviously solve the 8.5 plus 140 in the parentheses first, which equates into 17 million times 148.5. You pretty much have a stock valuation at around $2.5 billion per share. Now, that's the current valuation it should be at. Later on, when the company actually produces some outsized returns, you'll eventually see a company worth around $20 to $30 billion as the future continues to unfold. So does the projected price patterns and, of course, the projected value of the company, and therefore it continues going higher. Now, why is this company getting slapped around, beaten up, thrown off a cliff, and being massacred? Well, it's very simple. Institutions, like I'm saying, they plugged in the math, and they know for a fact that this stock is cheap, but they want it cheaper, and they also want to spook the amateur out of a very, very good investment. Now, I'm going to go ahead and tell you some key statistics on Ding Ding, and pretty much Ding Ding's market capitalization is $1,596,000,000, and according to this formula, the company should be worth around $2.5 billion. It's the same exact formula Warren Buffett uses to invest in companies, by the way, from a growth perspective. So if it was him, he'd be saying, well, if I buy this company, if I'm going to hold it on for the rest of my life, and these growth projections are accurate, and the economic implications are true, then I would still buy the stock and hold on to it, whether it goes down to $2 or $5. So again, from a trading perspective, yes, you are in a negative 100 score territory. The downtrend is definitely there. But let's go ahead and look at past history and determine whether or not this valuation is reasonable or unreasonable. Let's go ahead and look at history and talk about Baidu. Now, Baidu is a very, very interesting company. I'm just going to go ahead and show you guys Baidu's initial public offering and just show you like what exactly happened to Baidu. Like when Baidu went public, did it do the same exact thing as what you're seeing in Ding Ding right now? And in fact, yes, you actually see the same exact thing happen. I'm just going to go ahead and show you the charts. And pretty much Ding Ding, or not Ding Ding, but in our case, this is Baidu. Baidu started off at around $15 per share. That was the highest it got in a single trading session. It started off initially at around $7 or $6 per share. And around December of 2005, it went all the way down to around $6.90. Now, of course, the institutions knew that a search engine was going to eventually generate a lot of profit. Duh, look at Google. It was worth like a couple $100 billion at that point. Why not Baidu? Baidu is a great company. It's serving the same exact market, and of course, there's a ton of Chinese citizens. I don't see why Baidu couldn't earn a lot of money from doing the same exact thing Google's doing. And yeah, look, it's it's ridiculously cheap. It was ridiculously expensive after a bunch of hype, but then it fell off the cliff. Now let's look at the multi-year chart and see whether or not holding on to Baidu, even at $15 per share, even if you were a sucker and bought in at $15 per share on the day of the initial public offering, how good you would have done. Alright, let's look at a 5-year chart and look at the precedents. Currently, Baidu is trading at around $138.77. The initial public offering, $5.75. And even if you were a sucker and bought in at $15 per share, I have to tell you, you would be at a really, really nice profit, and you'd be laughing your butt off to the bank. So that just comes to show you guys that if you guys are looking at these Chinese tech stocks and thinking that they're a bit expensive and they have ridiculous PE multiples, yeah, they absolutely, the numbers look ridiculous. But when you put in a real growth formula, you come to realize that even Ding Ding is a little undervalued. And tomorrow's training session does hold a lot to be desired, but I do anticipate Ding Ding will go up. Following that, I'm going to go ahead and review Qihoo, which is a stock that just went public on Wednesday, 2011, March 30, 2011. Now, on the initial public offering day, a lot of people bought. They made a pretty decent amount of money. But on the following day, you saw a break right below a flag pattern, and the stock sold off. And you know what? That's what happens. And another thing is that same thing. You're seeing the same institutions play the same trick over. They're probably pushing down the price of the stock, therefore pushing out the amateur speculator into thinking that, oh, this company probably doesn't have a lot of potential. Markets are always right, which generally they aren't always right. In fact, generally markets are really irrational and sometimes even stupid. So, but to put it frankly, though, I'm anticipating the same exact pattern here. Promising company, unpromising technicals. Therefore, a lot of people won't buy into it. Even the investors will get pushed out of the trade as their stops are triggered. And eventually, over time, institutions will start accumulating a huge amount of shares. And eventually, 10 years down the road, it's the institutions who get to take the huge paychecks home, as the amateur tells their, I guess, their grandchild, oh, I used to own that stock, but I sold it 2 days or 3 days after they went public. Yeah, that's usually the case. So again, look at these Chinese tech stocks as stocks that are most likely going to be pushed off a cliff, and eventually institutions will come back and buy it back up. And you could either wait until then, or you could just buy now and say, hey, I'll just dollar cost average into this, or I'll just invest into it over the long term with a longer term mentality. Because if you had that same exact mentality with Baidu, you'd be doing extremely well right now. Following that, I do want to review Sohu, but I don't have enough time right now. I just want to go over this double topping pattern. And basically the point is that if markets are able to close above this trend line tomorrow as well, and we're getting some great data out of the Hang Seng tomorrow, then I believe a continued uptrend is in play for Sohu. Although I don't really believe in much more upside out of Sohu over the really long term. But you know what? I'll go over that in different videos. Anyway, take care, guys. If you guys want to use the same charting software I use, please be sure to check out the link right below this video and subscribe if you're into this kind of stuff.